The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody, ladies and gentlemen, hello and welcome to Nadex. My name is Philip and I will be your presenter for today's webinar. Today, it's all about the unique trading opportunities using spreads. Spreads, one of the two instruments available here on Nadex, and today we want to really lay the foundation of what are those spreads, how can they be used, how do they work, how do they tick, what are similarities, what are differences compared to binaries, for example. If you have a look at your webinar interface, you can see that small question box, and please give me a short yes or why to let me know that both the audio and the screencast are working properly. Perfect, Jason. Thank you very much. And all the other guys, really appreciate it. Yeah, and as usual, if you do have any questions through the course of this webinar, please put those questions in that box. I'll do my very best to answer your questions. I think asking questions truly is important. We want to learn something together. And yeah, please don't be shy. That's what we're here for today. You're not interrupting my flow, and I'll do my very best to help you with your questions. Today's session is scheduled to run for around about an hour. And of course, before we get started, there are our usual risk disclaimers that I need to make you aware of. So please take a moment of your time to read through them carefully and make sure that you're okay with them. Essentially, this says that trading, of course, involves risk. And you should understand those risks and the instruments you are using before you are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. Especially true for live webinars. Today it's all about slides. Today it's all about theory and foundation and case studies. And so please make sure that you understand that those screenshots that we have there do definitely not reflect current market conditions. And even if they did, they would never be some kind of trade recommendation. Everything that we do here at Nadex is really just for educational purpose. So please make sure you're okay with this before continuing with the webinar. Here's another risk warning, this time from Nadex. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying instruments in these asset classes: forex, stock indexes, commodity futures, cryptocurrencies, and economic events. Nadex binary options and spreads can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's just get started with today's webinar, which is brought to you both by Nadex and Trade with Position. So I would like to kick it off with a brief introduction of those two companies. Nadex, of course, we have gathered here to do that webinar, so I'm pretty sure you guys know who Nadex actually is. Nadex is a derivatives exchange subject to regulatory oversight by the CFTC, newly formed in 2007, based in Chicago, the financial heart of the futures and options market. All contracts are settled in cash, no physical delivery. Those of you who had exposures in futures markets and options on futures and suddenly got those calls from your broker that delivery is inbound, you don't want to be there. Usually for people like you and me, it's all about cash settled markets. And this is why here with Nadex, you don't have to worry about those risks about taking physical delivery. Wide range of global markets available to trade, and you have two unique vehicles to trade those markets: binary options and spreads. I'm running this session for Trade with Position. We are a trading education company, and we have been the company has been created by our founder Nick McDonald back in 2006 to provide education for retail traders. Actually, it's a fun little story. Nick was happily trading the markets on his own, never had the intention of creating a trading education company, but he was doing so well, his broker noticed what he was doing and how he was doing it. And so his broker gave him a call and said, Nick, please couldn't you teach our other customers the way you are trading? Because in the end, if you think about it, it's a win-win relationship. The broker, the exchange, makes money when you are trading, and you will only be trading in the long run if you're successful. So both exchange and broker have the most interest that you guys actually start to make money and that you become professional traders, that you are becoming successful traders in the markets. And yeah, this is how everything got started. We have been providing international trader training for clients of global brands and retail clients, including exchanges and brokers worldwide since then. And we teamed up with Nadex in 2011. We are a company run by traders, for traders. Sorry that I'm not a professional presenter, but I trade those very same markets as you do, and for that reason, I know what I'm talking about, and I know this to be 100% true for all of my colleagues here at Trade with Precision. We are specialists in trading strategy. You want to have a strategy when you enter the market. It shouldn't be gambling. You need to have a plan, and that plan is your trading strategy. You can access the markets here at Nadex not only using the web-based interface here on your desktop, PC, or Mac or Linux machine. Essentially, you have also apps available for trading the markets. You see here those apps available, and definitely also, of course, on your normal desktop. So if you haven't looked into those other options to access your Nadex accounts, please give it a try and check it out. Today's agenda, today it's all about spreads. And first we want to understand what spreads actually are. So understanding spreads, and then why should we bother with trading spreads in the markets? What are the advantages of trading spreads? Now, with options and binaries and spreads are no exception there. You should think about multiple aspects of your trade. And those multiple aspects include timing. Those multiple aspects include strike price selection and so on. And Jason is already asking a very good questions. Do the Greeks affect spreads the same way they affect binaries? Jason, great question. And yes, definitely. We want, if you don't have experience here with the Greeks, guys, don't worry. Personally, I think the Greeks are always a worthwhile endeavor, and it's always worth to understand and learn what we're doing here. But however, you don't have to know them in detail to begin with. But of course, obviously, what is the underlying of those spreads? We will talk about that in just a few moments. But in the end, it's just a vertical spread. And for that reason, the Greeks for each of those legs definitely apply. Jason, great question. And yes, absolutely. So multiple factors going into the construct or determine the value progression and how the value of a spread will change over time and over underlying price movement and changes in volatility and so on. And so you want to understand which is the right contract or which contract makes sense to trade. I don't think that there is a right contract to trade, because it's always your expectation and how you want to incorporate that expectation with your strategy. We will look at those factors which can help you to select the right contract for your implementation of your trading strategy. We have some practical examples, some practical Nadex spread trading scenarios as screenshots to talk you through those different decisions and the different aspects that make sense to look into and worry about when it comes to trading those contracts. And we want to close today's session with how you guys can actually easily start trading here on Nadex really today. So we want to get started with understanding spreads. So what actually is a Nadex spread? A spread is an options trading strategy simplified and prepackaged into one single contract. You have a floor level of that spread, and you have a ceiling level, a ceiling value. And within the range of those floor and ceiling prices, the value of the spread can alter, can change in line with the underlying price of with the price of the underlying market. You can easily buy and sell Nadex spreads contracts to create long and short positions based on the underlying market. And now, Jason, this is where your question already starts to kick in. A Nadex spread is similar to a popular option strategy called a vertical spread, where a trader simultaneously buys and sells two option contracts within the same expiration time but different strike prices. So those of you guys who have some previous exposure with conventional options, plain vanilla options, essentially what you're doing here with the spread is you have here, you have here the price of the underlying. So this could be 100, and this could be 150, for example. This is the price of the underlying, and what we're doing here with that spread is we're going long one call, so that this is plus one call at a certain strike price, and we're going short another call at a higher strike price. And so the payoff diagram would look like that for this strategy. And what happens here? Well, essentially within that range here, between the floor level, the lower strike price, and the ceiling level, the higher strike price, within that range, the market price adjusts, the market price floats within that range. And then it's capped off at the ceiling and it's capped off at the floor. That's the most basic idea of what this spread actually is and how it could be implemented using plain vanilla options. If you don't have a clue about plain vanilla options, don't worry about it. It's just with this basic model in your mind, it's easier to understand certain characteristics. For example, later on we will tell you that time value is not as important as with binary options or with normal single options. Why? Because you have an offsetting position here. You are delta short here with that long call, but your delta, you have theta short here with that long call, but you have theta long, so the effect of time exposure is definitely diminished. Just keep that in mind. If that's completely new for you, don't worry, forget about it. So, spreads versus binary options. Those are the two assets or two instruments available here for trading at Nadex, and so a very brief comparison should make sense. Binaries are straightforward. Binaries, it's a all or nothing payout on expiration. At expiration, you will check if the price of the underlying market is above the strike price. If yes, hooray, payout 100. If not, zero payout, nothing. With spreads, it depends on where we are in the range of that floor ceiling area. And so we do have a variable payout on expiration. Those 0 and 100 levels on the option are based on binary option pricing caps, profit and loss. And with the spread, you have predetermined floor and ceiling prices based on underlying market caps, profit and loss. Within the floor ceiling spread, price is closely related to the underlying market. It's not adjusting one-to-one, but it's moving very, very closely. With binary options, that delta effect definitely is a little bit more difficult to describe and to visualize. Price is based on a combination of market price and time to expiration. Once again, time to expiration also does play a role here with spreads. I'm not 100% agreeing here that here time theta effects, time decay is put so much emphasis on, and here it's not so pronounced. It's there as well. Keep that in mind. Time plays a role. Not as much as here with binaries, but it does play a role. Time decay is less significant due to the variable payout, with some exceptions that we will be discussing. And with binary options, it's a all or nothing payout, mean that time decay is a more significant factor. Price volatility near expiration is never higher than volatility of the underlying market. And here price can be very volatile near expiration if price is trading near the strike price. This is also called as gamma risk. Gamma is just a measure of how fast your delta will change. And if you're trading at the money, if you're trading at the strike with very little time left to expiry, your gamma is shooting through the roof. You can easily explain why that's the case. Think about you're just trading just 1 pip below the strike price, or you're trading at the strike price. That option at that point in time is worth nothing. And just a pip higher, suddenly it's worth 100. That's the thing that you have here with binary options, and this is why trading at the strike price with very little time left there is really starting to become very, very volatile towards the end of that option life cycle. Let's have a look at what the order ticket looks like and where we can see those floor and ceiling prices. We do have here a spread on the Wall Street 30, which is of course the Dow Jones. And on this Dow Jones spread, we are looking here at a floor level of 17,600 points and a ceiling level of 18,000 points. And this means that within that range, price of this contract moves very, very closely to what the underlying market is doing at that point in time. If it's trading below the floor and above the ceiling, it's still pretty much stopped at those levels. It can move a little bit. Again, this will then be time and volatility and so on. But in general, the movement, the payout structure at least, is really kept between the floor and the ceiling level. Currently, this market here is trading at 17,971. So we're currently trading very, very close here to our ceiling level. And or more the bid and the offer are very close here to where this market is sitting here at the ceiling level. Now, what does this tell us? If I want to buy this contract now, I would have to pay 17,975 points for this. The maximum payout is 18,000. So I'm paying 975. My maximum ceiling is 18,000. So my maximum profit here would be just those 25 points, those 25 bucks remaining here in that direction. However, if the market starts to go against me and I bought this contract, well, if it starts to drop like a stone and goes to 17,600, I will participate with all that downside move here. So we can see that with this contract here in this example, for example, reward to risk ratio is not really the perfect thing here to note about that contract, at least for a long position. I'm risking now $375 for a potential to make $25. Doesn't make sense for me. I don't say that this is a bad trade. It's just not something that makes sense for me, and I don't like that kind of risk structure. If I'm risking $100, I want to have at least the opportunity to make $100, preferably 150, 200, 300. But risking 375 in order to make just 25 doesn't make sense. Short side note here. An awesome thing about those Nadex contracts is that you immediately see what your maximum loss is. That's it. Even if the market opened at 15,000, if it dropped completely somewhere else, it wouldn't matter. You are capped here at 17,600. You know your maximum loss on this one contract upfront, which makes applying proper risk management and position sizing very easy, straightforward. Risk management is boring, but risk management keeps you in the game. Risk management is for survival and long-term growth. And just this feature here, seeing what your maximum loss is, not likely, but really hard, your maximum loss. This is so powerful. I really like that aspect and feature here very much. All right, so floor and ceiling price scenarios. When the underlying market is trading below floor or above ceiling price, the Nadex spread will be trading close to or around its floor or ceiling price. Remember, the value of that spread is only moving inside that range. So if price drops below that range here of, let's say, 12,400, if it's trading at 12,400, it will be worth approximately the same as if it was trading at 12,390, 12,300, 12,000 straight. 11,000 wouldn't make much of a difference because it's capped here. It's sitting at 12,400 plus minus a few bucks. The ceiling price, it's just the same story. If that market goes to 12,790, that's it. 12,800, perfect. If it shoots to 14,000, 15,000, doesn't mean a thing. Price will probably still be very, very close here to 12,800. Price of the spread moves within the range that is given by the floor and the ceiling. So if you think that the market might be going higher, you think the market might be going to 13,000, it doesn't make much sense to buy now a spread with a floor level of 13,000, because if price moves here from, let's say, 12.7 to 13, all this movement here would not be used by that spread with the floor level of 13,000. The price of that spread only would start to move once price starts to push beyond 13,000. So Nadex spread prices will move very little until the underlying market is trading within the floor ceiling spread. However, within the spread range with time remaining, Nadex pricing and underlying pricing tend to have a very high correlation when the underlying market is trading more in the middle of the spread range. There will be less correlation as the underlying trades closer to either of the spread strikes or outside of the range. Jason, I'm 100% sure that this example or this behavior can be perfectly explained and summarized just by summing the two delta components of the long and the short call. And this is where I would suggest that yes, the Greeks affect definitely spreads, and this explains the behavior of those prices. We sometimes get the questions that price isn't really moving as expected. And this is where we would have to look deeper into the structure, what actually makes that spread, and look at delta and really explain why it's behaving the way, why pricing is behaving the way that it does. All right. Selling spreads, reward versus risk. I'm looking here into selling a spread. Now, I could be selling a spread at 12,700. And my maximum reward here would be 300 points. Why would my maximum reward be 300 points? Well, if I sold at 12,700 and it dropped to 12,400, that's 300 points difference. If the market is moving against me and we're making higher highs here, or if price is going higher, sorry, forget about the higher highs. If price is going higher, well, my losses are capped at 12,800. That spread can't settle for more than those 12,800. So my maximum risk are $100. Maximum reward 300, maximum risk 100, reward to risk 3 to 1. That's one possible contract to sell. Another one which might be available at that point in time would be I could also be selling the 12,500 contract. Same idea, price could be going down to 12,400, and so my maximum reward is $100. Nothing bad about making $100. However, if price is not behaving as I anticipated and starts to rise and starts to go to 12,800, my losses are only stopped. My participation in the price move will only stop at 12,800. So this means that I'm now risking $300 for a potential profit of just 100 bucks. And this now gives me a very bad reward to risk ratio of 0.33 to 1. I'm risking $1 in order to make 33 cents. I don't like that. I much rather have that set up here on the left side where a risk of $1 could make me $3. Same thing, of course, is true when you think about buying spreads. If you thought that you would buy this spread here, 12,400 floor, 12,800 ceiling level, and you entered at 12,700, you will be buying for 12,700. What's your maximum reward? Well, it can just participate in the up move now of $100. However, it could drop $300. Very bad reward to risk ratio. Personally, I wouldn't bother to take that trade. However, if I entered a spread rather close to the floor level when I wanted to buy, now my risk is just $100 to the downside, and my potential to the upside would be $300. Again, I do have my 3 to 1 reward to risk ratio, which I do prefer. Is that idea with the reward to risk ratio, is that clear? Are there any questions on that? And if there are questions, then please don't be shy. This is not that you didn't get it, but rather that I probably explained it not very well. So please don't be shy. Let me know if I should elaborate here on that idea with the reward to risk ratio just a little bit more. So what are these components of my spread? We covered those very briefly already in one of the previous slides. First thing that we're noticing here is the underlying market. It's the Wall Street Dow Jones September futures contract, underlying asset, and this could be any major index futures, spot FX rate, commodity futures, and so on. Next thing is, when does this contract expire? When does this spread stop trading and actually expire? When is the cutoff point when will be decided, okay, how deep in or out of the money has that contract now, or is this contract right now? And therefore, for how much is this contract to be settled here? Expiration time and that date. And here we do have the spread price, of course. This is where you could sell. You could sell this contract now for 17,991, or you could buy this contract now for 17,995. Where are we with regard to the floor and the ceiling? We can see the floor here, the ceiling here. We are around about here in the middle of that whole contract, of that spread range. If we look now into selling this contract here, and we're looking here at a different contract, 17,600 to 18,000, selling this contract at a price which is very close to 18,000. So we're selling very close to the ceiling of that contract. My maximum profit means that price where I sold it now is going down all the way to 17,600 during the lifetime of that contract, or at expiry of that contract to get it finally settled. So if that happens, my maximum profit is $371. My maximum loss, however, is $29, or here in this example now $28. It's just, or yeah, 29 with the commission. It's just, okay, I sold something very close to the ceiling. Where can it move to? If it goes against me, it can move exactly to the ceiling. And for that reason, it's capped there at 18,000, and so my maximum loss here is $29. I can see all this here immediately just looking at the order ticket. I don't need to have any fancy Excel spreadsheets or other things. I have everything that I need in order to make my trade and my trading decision here right on the platform. Buying that spread, okay, I can buy the spread for 17,975. Where can it go to if it starts to rise? Well, it can rise to the ceiling, to 18,000. This means I have a maximum profit of $25. If it's going against me, it can drop from 17,975 to 17,600. I can lose the $375 on that trade. This is a very nice reward to risk ratio on that trade, risking 29 in order to make potentially 371. Here I'm risking 375 in order to maybe just make 25. Doesn't make sense for me. So what are the advantages of trading spreads? And just a quick same reminder, if there are any questions, please let me know. Minimal startup requirements, small startup capital requirements, trading on Nadex with as little as $100. There are no platform fees involved or minimum trading requirements. You just need one single account to trade all different markets. You can trade commodity markets, you can trade index future markets there, you can trade forex markets, cryptocurrencies. It's all there. You can trade binaries and spreads on all of those underlying markets. You want to consolidate your cash to trade contracts based on spot FX, commodity futures, index futures, invaluable supplemental tools for the experienced traders, and you have great introductory tool to new markets for the novice trader. So no matter what kind of market you want to trade, you have access to those markets here at Nadex. Risk management. Jason is asking another good question, and Jason, honestly, I don't know the answer to that. But somebody from Nadex will be in touch with you and will let you know the answer. Before I tell you something which is just not right, I'll pass that question on, Jason, if that's okay with you. Risk management. I already explained that risk management is boring, and it's so powerful and it's so necessary. Risk management keeps us in the game. We must make sure that Daniel, yes, sorry for not mentioning that. The question was really on the minimum account size, if it was those $100 that we mentioned here on the slide, or if that had changed in the meantime. Nothing to worry about, but we'll make sure to follow up there. Daniel, thanks for the follow-up. Risk management keeps you. We must avoid at all costs that one bad trade wipes out our account. That's absolutely crucial. We must be able, no matter what happens today, that we will keep our account in such a shape that we will be able to come back and trade and try again tomorrow. And risk management is that powerful thing. And a crucial component of risk management is money management. We must know what the risk on one trade is. How much money can we lose if that trade is not working out? And the trade not working out is not a sign that we screwed up as traders. It's just part of the game. Trading is all about statistics and probabilities, and we cannot win every single trade. I know this would be very nice and it's so tempting and alluring. It's just not working that way. Trading is about hopefully being right more often than not. And on those times when you have potentially profitable trades on your hand, you probably want to cash in more than you will lose on the losing trades. And this is why that reward to risk ratio was so or is so important to me, because that's the part of the equation where I say I want to potentially make more money than I lose on my losing trades, and that's my reward to risk ratio. If I lose $100, that's okay, but I should be able to have more potentially profitable trades, which means more happy events than sad events. And those happy events, my reward to risk ratio 3-1. If I lose 100, but if I win, I make 300. And those two things coming together, this is what should give your account a very nice equity curve in the long run with some experience. The very nature of Nadex spread contract is that they limit our risk, and risk is known in advance. This is so powerful. This is not something that you get with a lot of different other asset classes. I know upfront my maximum profit. I know upfront my maximum loss here. And it's really, we are capped at this level. Daniel, thanks for the input. I'll just forward your input the same way to my Nadex guys than that of Jason, and we will follow up on that with you if that's fine. All right, so a wide range of markets reflecting underlying futures is available. You have energy, you have metals, you have agricultural. When we're looking at commodities, and here really crude oil, natural gas, gold, silver, copper. You see all those different expiry cycles here, delivery months in the future contracts, and where those markets are being traded, corn and soybeans. That doesn't mean a thing. You don't have to worry about that. Those markets are available for your trading here at Nadex. That's the takeaway for me here. Same thing is true, of course, when we're looking at index markets. You have US indices. Obviously, Dow Jones, S&P 500, the Nasdaq 100, the Russell is available for trading. European indices, FTSE 100, UK, Germany 30, the DAX, and the Nikkei in Japan as well. Low tick values, you have the minimum futures tick value, the minimum Nadex tick values. You see also those price changes are smaller, lower tick size equals more precise money management, ease of access for smaller position size traders. And if you say, wait a minute, I really have to shell out those $100 per trade when it comes to trading binaries, no, you don't have to. It's a matter of proper strike selection and proper contract selection, and it's crazy with that how you can trade, how many contracts you can trade with proper risk management on small accounts. It's really quite powerful. Maybe we should be doing a webinar about that in the future as well. Guys, if you do have any suggestions for future webinars, please let us either know now here in the questions box, or shoot the guys at Nadex an email. We're always happy to get more input there for future content. Overall account risk limited. When you place a trade, your maximum risk is clearly displayed. No nasty surprises, and this amount is held by Nadex as collateral. For example, on a 200-point spread contract, if you buy at 35 above the floor, your maximum risk is 35 points. And those $35 will be held until the trade is closed out. The seller on the other side has sold at 165 points risk and will put up the remaining 165 collateral contract. In all cases, the exchange always holds 100% collateral to pay out the maximum possible outcome on the trade. So this means that you cannot lose more money than what is in your trading account, and all contracts are cash settled. There's no physical delivery, and Nadex can make sure that those cash settlement actually occurs. Why? Because here in total they have gathered 100% collateral. Range of spreads available. Here we have the contract selection box, and the contract selection varies based upon the market. Index and commodity futures are available on hourly and daily expiry cycles. Forex is available on hourly, 5-hour, 8-hour, and daily cycles, 70 contracts per currency pair per day. And we just pick one of those markets here available. You see you have the binaries and you have the spreads. So we're looking here at Forex spreads, and you can see, all right, for the Aussie against the US dollar, we can look now which expiry cycle is interesting for us. We click on that, and then the contract list opens up, and on that contract list you can see, all right, it's a spread. Yes, it's on the Aussie against the US dollar. That's my floor level, that's my ceiling level. How much time is left? What is the bid and the offer, and at which sizes? When will expiry actually be? The nice thing with the completely risk-defined structure and way that those Nadex contracts have been set up is that you definitely don't need traditional stop losses. Why? Because why are we using stop losses? Because we want to manage and define our risk. If something is not working out, I want to close that position before I lose the farm. But I'm not risking the farm with those contracts here. I know my risk up front, and with proper risk management, money management, position sizing, I made sure that the position is small enough to be in line with my trade plan. And for that reason, I don't have to manage that position and get out. Of course, I can do so if I want to. Those contracts here are not fire and forget. You can easily trade, add to your position, trade out of your position by closing parts of your existing position at different prices with limit orders, with stop orders. All this is possible, but you don't have to do it to implement a proper risk management plan here at Nadex. Once again, if you are trading near the floor or ceiling prices, risk is capped. No way that this will be going higher than the ceiling or lower than the floor. Price can move beyond the floor ceiling and you still stay in that trade. What's the nice thing here? It can come back. If you're stopped out and that position is closed. However, if price just briefly dips below the floor level, but there's still 7 hours left in the contract life cycle, and then this contract starts to rally. With a conventional stop, you would have been stopped out. Here, that trade is still good, and once it's back in and we still have time left in this contract, that contract will appreciate in value and go in your way. So another powerful feature here, you stay in that trade. You know your maximum loss up front. I know that's repetitive at that point in time, but this is crucial. Risk management is so critical, and here you see your loss. It's so easy to implement proper position sizing here. Direct market access exchange. Nadex is the exchange, and you trade with direct market access. Nadex isn't your broker. You're trading at the exchange. You're becoming a member of the exchange. And this means you can place limits at your preferred trade price, even with the current bid-offer spread. Tighten spreads yourself. You make your own market. You are directly trading at the exchange. There's no middleman there. You put your offers in there, and those offers and bids and asks, they do show up immediately here on the platform. Nadex spread pricing and selecting the right contract. Pricing in time and volatility. Spreads do not generally have a large time element priced into the contract. The contract price should be tracking in line with the underlying, provided it's within the floor ceiling range. Let's have a look at this on the next slide here. We're looking once again at the Dow Jones. Contract snapshots last 3 to 4 hours of trading. And we're looking here at those different points in time. Price dropped down here. Just a second while I read those questions. Bruce is asking about the way that those different ranges have are established, how those contracts are being created. I think that's a first for me, that this is the third time today that I say, Bruce, great question. I will pass this on to Nadex because I don't know how these ranges are established. I could speculate now. I have some good guesses, but I don't know for sure. Just a second. Just a second, guys. The questions interface is going a little bit crazy here on me. All right, Bruce, thanks for that question. Really, really good question. I will forward that as well. If that's okay with you, Nadex will be in touch with you and give you an answer there. So you see, price dropped down. We're sitting here at this first level here at 12,632, which is pretty much in line where price is trading at that point in time. Then market starts to rally, goes higher. About 2 hours later, you see we have rallied here to something very close to 12,700. Guess what? That contract is trading very close to 12,700, and prices started to decline a little bit again. We're trading here very close to 12,600, 12,608. Where are we? 64, and once again we're rather close here to where the underlying market is trading at that point. Sorry guys, that was the first one. Second, and here very close to where the price is trading at that point in time. So you see that this time decay is not really so much of an issue. Why? Because we are in that range and price is moving pretty well along. Here it's just 10 minutes to expiry to expiration. So it's still tracking price very, very closely here. When is price tracking not in line? There are some exceptions. Price may not be in line with the underlying when Nadex spreads contracts have just opened for trading and have a significant amount of time left to expiration, or if spreads are trading close to their floor and ceiling with significant time left to expiration. At those points in time, volatility definitely comes into play here, and therefore prices there will be skewed. But once we move back into that spread range, prices will track the underlying market price again pretty well. Prepare to factor in extra price for the time advantage until expiration, and as time passes, the spread contract will gradually get closer to the underlying market price here. So when is tracking not in line? Let us say we expect the Aussie to decline from the price of 73.70, so pretty much where we're sitting here right now. More time until expiration is more dollars. Which contract will you trade and why? Well, we could be going here for the 30 minutes to expiration contract, the 90 minutes, or the 2 hours and 37 minutes. And you can see that here we're trading pretty close at the money. Here, this contract is already more expensive, and this contract here is paying pretty much at the same price here. You are paying here for the privilege that you do have more time in that contract and that it starts to actually move in your direction. So why is that the case? We're sitting really, really tight here at the ceiling level, and in this area, more time. I wanted to say that at this, if you're trading at the floor level or at the ceiling level, the behavior of that contract might become similar to that of a binary option at the strike price. Not entirely true from a Greek perspective, but maybe that's a helpful model. If you are far out of the money, behavior is clear. If you are in the money, in the range, behavior is clear. around the edges, it might be a little bit rough. Let's put it that way. Time limit risk on trades. While time decay is not a significant risk in the pricing of Nadex spread contracts, it is vitally important that you give your trade sufficient time to work out. There is a potential opportunity cost that the market will achieve your target, but only after expiration time. Let's have a look at an example here. We're looking here at a potential short setup. If that's your trade plan, you think the market might be going lower, happens to be crude oil, but honestly, it doesn't matter at that point in time. Here, no, sorry guys, here we say crude oil, here it's the Russell. It doesn't matter what the market is. Let's just agree on that. And the market might be going lower. What is my contract here? We're currently trading at 813. Here, we're pricing this contract at 806. What is the range of that contract? 785 to 810. So 810 down to 785. So we're trading very, very close here. The underlying market currently is above the ceiling level. Now, what is my risk on trading one contract here? The platform immediately tells me, Philip, if we trade one contract here, my maximum loss is $42. Why? Because I'm capped at 810. I'm selling now at 806 and I'm capped at 810. My maximum profit, however, if the market starts to go down and actually hit this lower floor price, my maximum profit would be 208. And guys, when I say it hits that floor price, I do mean it settles when this contract expires down there. In the meantime, yes, there's nobody preventing me putting in limit orders to try to close the position early on. But this contract finally does settle at expiry. Keep that in mind. So I think nice opportunity here. We have a maximum loss of $42, a maximum profit of 208. So risk, reward, 42 ticks, 14 hours to expiration might be a nice setup. However, didn't work out here. You may be right on time, or you may be right on the direction of the trade, but wrong on the expiration time. This is pretty much when we looked at that setup here. And sure enough, price started to push lower, but it came back. It came back. This contract settled back in here when it was above the ceiling level. So I did realize here my maximum potential loss on that trade, only to watch the price finally started to push again in my direction and actually hit and go in the direction that I was anticipating. So I was right on the trade, but my timing was just wrong. This trade resulted in a small loss at expiry and later continued in the expected direction. Well, how can we prevent that in the future? We can be vigilant in selecting expiration time and where possible choose the contract with the most time left. Again, if I go that route, I definitely want to manage that trade. I will definitely want to have some kind of profit-taking orders in place that allow me to scale out of my position and take profits once price is moving in that direction. The nice thing is, yes, the spread moves along with the with price movement of the underlying. So I definitely know roundabout where this spread contract should be trading if it starts to go in my direction. So nothing wrong with actively managing your trade there. Something that you can also do is you can try and split your contract or your position, your trade into multiple contracts. You can spread out those different expiration times, and we'll have a look at that here on the next slide. I want to risk the same amount on any trade setup. This means that if I'm wrong on a $10,000 account, I'm happy to lose $100. That's okay, that's in line, it's accounted for. However, if I think that I want to spread out this here now over two different expiry cycles, a 7-hour expiration and a 1-hour expiration, I must adjust my position sizing. This means my total risk of those two positions, that should now be $100. And how you want to distribute that is completely up to you, your decision. But my total risk exposure here should still be my total risk parameter for my trading. So keep that in mind. What are we looking here at? Well, we have a 7-hour expiration, so we're looking here at this. We're looking here at those numbers are off here and do not match what we have here cycled. Sorry, guys. We're looking here at one in the range of 106.80. 106.80 is starting here at this level. And we're looking at another one, and the floor level is 109.30, which is sitting around about here. So actually, this one should be the green one, and that should be the red one. And the question is, which is the better one? Well, obviously, if I want to go short in that setup here, the green one, the 7-hour expiry, would give me the better range, because I'm able to enter very, very close here to my ceiling level. For the other one, I can spread out my risk. I'm sitting here right at the in the range pretty much, and therefore I could pick that one as well. I could try to balance between those different expiry cycles here. Risk: selecting the wrong contract. Selecting the wrong contract could create an undesirable reward to risk scenario. Clicking buy instead of sell, and that's the reason why I always double check really my potential risk, my potential profit. If those numbers just don't make any sense for me, I better double and triple check everything again. A popular technique is to find a Nadex spread trading close to the floor or ceiling or slightly in the money. When using this technique, make certain you select the right contract near the floor if bullish. So you want to enter as close to the floor. Why? Because if it drops, you fall just a little bit. And if you want to short, you want to enter as close to the ceiling as possible, because then if it keeps on pushing higher, you bump your head after just a few inches, and that's it. So always, well, probably there's an exception, but my rule of thumb is, when I'm looking at those contracts, I'm really try to pick spreads at the floor level if I want to go long, at the ceiling level if I want to go short. Practical Nadex spread trading scenarios. So we're looking here at the Aussie US dollar trading exactly at the ceiling level. What's the ceiling level? 73.70, and this is where we're sitting here right now. 2 hours until expiry. And if you had a bearish view on that trade, there's a great reward to risk ratio with no stop loss requirements. Why? Well, I'm trading at the ceiling here. My maximum loss is just $6 if I solve that contract. My maximum profit, if it goes all the way to 71.70, 71.70. This is way down here below. Is this realistic? No, I don't think so. But it doesn't matter, because it just has to drop $6 and I'm already at a 1-to-1 profit target. It just has to drop $12 and I'm going for a 2-to-1 profit target. So it's not that it has to go all the way. If it just moves in my direction, this can already be quite profitable, potentially profitable. So entering very close at the ceiling, $6 risk for a maximum profit per contract of 194. Selling a downtrend. If we think this market might be in a downtrend, we see that this one contract here is at the offer 108.340, and this one here has a ceiling level of 108.30. Very, very close. I can sell this contract here now. What's my risk? Well, my risk is that it goes higher. It settles at the ceiling level. So I'm paying now just, what am I paying for this contract? I would be paying here, my risk is just $12 here to the upside. Or in this example here, when we took those screenshots, it's 15 pips. That's my risk. If I wanted to trade that setup with a conventional stop loss, my stop loss would have to go here above the swing point high, which is way farther apart than the risk that I'm currently taking here with that Nadex contract. So here, contract is only way closer. I'm risking way less, which means I can be trading a larger position. I want my total money risk to be the same. My de facto stop is closer. Therefore, I'm risking less per contract. I can trade more contracts. This contract is only 4 pips out of the money and provides a great reward to risk ratio for this trade with plenty of expiration time remaining. And this contract proves or provides the best reward to risk of those available contracts. If we compare those other contracts, we see that we are either trading pretty much below the floor. We are trading right in the middle. This is the only contract here that allows us to really precisely enter at the ceiling, giving us all the potential for a downside move, but pretty much no further risk here to the upside. What happened next? That trade could have yielded a profit in excess of 45 pips, a 3-to-1 reward to risk ratio. The 15 pip risk scenario and the resulting 3-to-1 profit was much better than what the spot market could have offered. So clearly managing our risk and also getting us a better payout structure here with that trade using Nadex spreads. With a bullish bias on that trade here, select the optimal contract. The first 2 contracts are in the money. The third is out of the money. The risk by contract for the blue, and we have those boxes here in once again, the risk for the blue contract is 19 pips. For green, which is in the money, just see where we are. For the green, we can drop all the way down here below. That's a lot of risk. I think that's more risk than here potentially to the upside. And the red box, we're trading above the ceiling. We can't provide, we can't actually move higher than that here at that point in time. So it's, yeah, red 141, and again, it's already out of the money again. Red contract can be disregarded for a long trade. The ceiling provides a profit limit. It won't appreciate in value even if it goes to the moon. So the blue box here, the blue contract, which allows us to enter pretty much at the floor level at that point in time, is providing us with the best reward to risk ratio on that trade. What happened next? That trade resulted in a 50 plus pip profit and a 2.5 to 1 reward to risk ratio. The green contract would have yielded just pips additional. Why would that green contract have given us more profit? Well, it would have given us more profit, coming back to my Greeks and delta, because obviously it was deeper in the money. Delta was higher and therefore it appreciated more in value. Simple as that. It's close enough, but just see how much more risk we would have needed to take on that green contract. Price can drop all the way. So much more risk for just 10 pips more profit doesn't make sense for me. For the extra risk of 60 pips, very little added benefit for a lot more additional risk. Let's have a look here at a slightly out of the money contract. This green contract here, price could still push higher and move in that territory. However, as long as price is not moving into this territory, is not moving above the ceiling level, above the floor level, it won't appreciate in value. Value appreciation only will start once it's in the money, once it's moved below, above the lower strike price, above the floor price. This is when it starts to appreciate in value. When buying out of the money contract, price will stagnate until underlying reaches the floor price, then roughly point for point as underlying price improves, and there's seldom a benefit to buying deep out of the money contracts. Look for a better trade. If you bought now something with a, let's just draw this in, and guys, we just have 2 more minutes left. I definitely will be over time. I'm sorry about that. Let's just assume you're looking at a spread with a floor level right here. And now price starts to rally. Guess what? Everybody who has bought here is already happy. For you, the party would only start if it starts to move beyond this level. But honestly, it has traveled quite a bit at that point in time. Probably there will be some kind of pullback. So even if it hit your floor level, there is nothing to pay you. There is nothing actually to there is nothing to actually reward you for making that call. And that for that reason, going for those trades which are out of the money, far out of the money, just doesn't make sense. You want to have some delta there, and you get that delta if you enter at the floor or the ceiling level, ceiling for a short position, floor level for a long position. So that contract yielded 30 plus pips. Price actually pushed higher, went all the way for over 4-to-1 reward to risk. That contract would have yielded 45 pips profit, but a significantly higher risk of 43 pips versus the 8. You could have potentially traded up to 5 times the contract volume for the same capital risk by selecting the optimal contract. I know that this is very fast, but guys, look at those contracts, and this is why I can highly recommend using a demo account here with Nadex. And why? Because you can practice all that without putting a single dollar on the line. Yeah, you get used to the platform. You can practice your contract selection, and why not implement several trades at the same time and just see how they behave, how they work out in the long run. So that's the basic idea here. Use the demo account, demo platform, time unlimited, powerful feature. Get used to doing that. We're looking here at the US dollar against the Swiss franc, and which contract of those available here would you decide? Price has pulled back. Price has pulled back and out into a moving average buy zone. We're looking here for potential long trading opportunities. So I would be looking for something to buy here. And at that stage, where are my levels? We are trading here at 88,540, and I'm searching now something where the ceiling level, where the floor level is very, very close to where we are trading right now. Those two contracts here are closest to where we are. 860, we could be going for that one. We could be going for that one. At least that's the idea here for that I would have that I would consider. Here we're already sitting in the range. Not sure if that's a good place to be. Rather, I'd be very close to the ceiling, to the floor, out of the money, preferably a little bit in the money. So what have we seen here? Price has moved a little bit to the upside, but then stalled. Price is not really going anywhere, and there's virtually no profit or loss on those contracts. Looking here at the 88.60, 89.60 would have expired at the floor price for a cap loss of 8 pips. Manage your risk, manage your positions, and I think that basic idea, what could be the process for strike selection and for spread selection range, I think that should have become clear by now. One interesting strategy that I want to mention here using spreads is there's a news announcement. Non-farm payroll numbers, gross domestic product, interest rate decisions, stuff like that. You don't know in which direction the market will go. And with conventional instruments, my suggestion would always be get out of the money. Get out of the market. You will see huge volatility. You will see spikes in both directions. It will be painful. You don't want to be there. However, with Nadex contracts, with spreads, this might become an interesting trading opportunity, potential trading opportunity. What you could do is you want to enter that spread where at the floor or ceiling once again. One thing that you could do is you might be looking into buying and selling spreads at the same time. You want to buy that spread where you are currently at the floor, and you want to sell that spread where you're currently at the ceiling. What's the idea? You have minimal risk exposure because you are trading at the floor or the ceiling of those two spreads. However, if the market starts to push in one direction or the other, price will move along. Price will play along. And so you have exposure to both sides with very, very limited risk. That's the basic idea looking at those two spreads here. News trade result, minutes after news release, the long contract is over 1-to-1 in profit. Prices started to push higher and moving higher to potentially hit multiple targets. The short contract may expire at the ceiling, or you could hold until expiration. Maybe, and this is what I just said, there's a tendency that price, especially after news releases, will spike in both directions. There's volatility in both directions. There's a decent chance that if you had take profit limit orders in place, that you might cash out on both of those legs. Guys, thank you very much for tuning in today. Let's do a very brief summary and wrap it up. Trading spreads on Nadex. Spreads provide us with a variable payout. How deep in the money are we? And this determines the value of that spread at expiry. Time decay is definitely not as much of a factor as it is with binaries. Major thing that you want to understand and get into is selecting the right contract, because this allows capped risk with significant upside potential. Low minimum tick size of just $1 offers another advantage over the underlying futures market, and you can trade a lot of different global markets and underlyings, indices, spot FX, and commodity futures just from one single account. No broker, direct market access. Nadex is the exchange, and you are about to become a member of the exchange. Here you see the different ways to be in touch with Nadex if you want to learn more. The slide still says 14-day demo accounts are available. Guys, the good news is those demo accounts are unlimited. Take all the time that you need to learn the platform, to learn the ropes, and yeah, get fluent with those contracts and add them to your trading arsenal, to your tool bench. Yeah, guys, about 6 minutes over time. Sorry about that. Jason, thank you very much for the feedback. Really appreciate it. Ludmila, thank you very much and glad to have you with us again. Yeah, guys, if there are questions, I'm happy to answer those questions right now again. And for those of you who have to leave, and if there are no further questions, that's it for today. It's a wrap. Thank you very much for tuning in. And yeah, pretty much looking forward to seeing you guys next time. Good questions today, and I'm pretty sure you will get those answers in case you haven't gotten them already. And yeah, see you guys next time. Have a great day. Happy trading. Take care. And thanks again, and bye-bye.